Is that music playing, Patty? Yeah. Is that pumping you guys up or what? Me a little bit. So I'll talk a little bit. That was a nice introduction. I really appreciate that. And all those good things that happened sound like I did them myself. I have 6,000 employees that work for me. Almost virtually everything that happened outside of my office. I do have a pure excitement about understanding this space and understanding what FinTech means, understanding where it's going, how it intersects with banking. And so when I got the invitation from Patty to come speak, the last time I spoke about FinTech, I talked to a bunch of bankers. I mean, I can't screw that up, right? They don't know. So here I am in the East Bay, the hotbed of innovation in the world. And Patty says, come speak to me, come speak to this group about FinTech and innovation. I thought, oh, I don't know, man. I don't know if I can pull this off. But I think that I can give a perspective on where the banking industry is coming from, what we're thinking about, how we're looking at it, what's real and what's not. And when we start thinking about FinTech, it can be a little bit scary at first when you read the headlines and you see what's happening in the innovation and what could be next. And it requires, I think, the financial service industry to take a step back and say what is really going on. And so in our business, that's kind of what I've tried to do, is compartmentalize it, understand what is real, what is not, what's going to catch on, what is not, what niches people are hitting, what they're not, what the customer wants, what they don't. And that's not easy to do, but for me, it's one of the most exciting things that we'll ever face in the banking industry in my career and in my lifetime. So I want to give some facts. I want to give some context. I am not going to teach you about coding and user experience today, but I might talk about where some of the work that you have or some of the things that you're looking at fit into the banking ecosystem. So starting right out of the gate, the thing that we talk about a lot at our company, and when we talk about our digital strategies, we've invested pretty heavily here in the last few years to catch up, to make sure we're ready, to make sure that we have the back-end connections, to make sure we're ready to go forward. And I threw a few stats on here because I talk about this all the time, and people get really excited about the millennials. Who's excited about the millennials? You're not a millennial probably if you raised your hand, right? Because apparently they don't like to be labeled millennials, which is fine. This is not a millennial game. Everybody's using digital. When you look in the upper left-hand corner, 55% of seniors and 70% of boomers expected to be using digital banking by the end of 2016, way out, the end of this year. Product sales, 44% of revenue from the digital channels. But when we think about what's going on, we are not simply looking at other banks. We're not looking at Chase and Wells and US and saying, okay, that's the customer experience, because we know the bar has been set. We know it's been set by the Amazons of the world, the Googles of the world, and they set the bar and they set customer expectations of what's going to happen next and where we're going to go. Looking at some of these numbers up here, I don't think they're very far-fetched. It doesn't mean that you're necessarily executing from A to Z online to be part of the digital ecosystem. You simply could be going online. You could be disintermediated with chat. You could be going to a call center. And we're studying every aspect of that to understand where people go and how they're going. And we're building the back-end systems to come to the front end. People said to me recently, your digital channels, you are not selling enough of XYZ product on your digital channels. Therefore, your digital channels is not strong enough. Okay, so first of all, the digital channels, the front end, it's ready. But the back end was not ready. Our credit approach was not ready. We are not playing the same game as some of our FinTech partners. And that's where we had to focus. You have to be at the front end. You have to be at the back end. You have to have the credit culture. You have to then have a digitized process all the way through. It's not a small undertaking, but it's important to understand that. Until the last year or two, banks absolutely didn't understand that. We have the FinTech community to thank for that, and we should thank them for that, because they're, in many cases, creating a better or leading to a better customer experience. Whoops, okay. So, innovative solutions to meet evolving customer needs, intuitive, transparent, customized. These are a lot of the words that they use. I would focus on transparent. I mean, that was the buzzword in the industry 3 to 5 years ago. We've got to be transparent. We've got to give people what we want. We're coming out of the crisis. There's a lack of trust in the banking industry. We must be transparent. Transparency leads to trust. Okay, so it's not a black box on how credit decision was made. In this particular case, I think this might be Prosper. Prosper talks about, well, they're trying to gain trust. That financial institutions, actually, if you look at individual customer surveys, they do have the trust of their customers. In order to be exceptional outside of the banking industry, you need to develop trust. You can do that in some of these many ways. Intuitive, basically self-service. The question is, and I just had this conversation with Bank of the West head of digital and wealth right before I came on stage. Robo advisors, self-selection. How far does that go? Is it just plug it in and that's going to play the whole way out? Or do you test the robo and understand when it goes from digital to human? Does it ever go to human? Does anyone ever want anyone to talk to when they're talking about their money? Sometimes yes, sometimes no. So here's the question of the day. How many people in this room have visited either a Blockbuster or a Borders store in the last 12 months? There's always one, right? Probably a drug screening issue at his last company. You're for sure not visiting those anytime in the near future. And so this is a stat immediately as a banker. If it doesn't get your attention, you are not paying attention. Because you say, gosh, no, surely this won't happen to us. I'm not sure this internet thing's going to catch on. That's funny. So clear that, and there are, what I want to talk about throughout this is why we should be scared, how we are like this Blockbuster, Borders disintermediation, how we're not like this disintermediation, and how we need to understand the components of where technology and financial technology is coming in to build a plan for the banks. And then if you're in the technology segment, how you should be thinking about how the banks are thinking about using technology in the future as well. So, can $22 billion be wrong? Because that's what was spent in FinTech in 2015. You go back to 2012, this probably has a pointer on it somewhere. I could do some damage, though, by trying to use it. Whatever. I'll point to it. 2012, $4 billion, 5x in investment. The first quarter of this year, $10 billion in FinTech. I don't think $22 billion is wrong. Of that $22 billion, what's really interesting to me, $7 billion of the investment. That's investment. $7 billion in investment is in consumer lending. That's at the very heart of the banking sector. So now we start to get attention. You see the Blockbuster slide. You see $22 billion investment. You realize that almost a third of that is in consumer lending. So then, this is a slide that I worked on with a team of people and a consultant that was interested. They did this for no charge because they were interested in how we were thinking about it. We were interested in how they were thinking about it. We brought a team of people and said, how scared should we be right now? And we decided we need to learn how to think about this and categorize it. So when I think about this, I go to the left-hand side. Not every FinTech is the same. On the left-hand side, you have the competing FinTechs. That's in the lending space. But by the way, all the competing FinTechs are not all competing. Some of them are on the far right in the partner space, and I'll talk about that in a little bit. You have trading and investments, which also can be a competition. It can also be a partner. You have the disruption. This disruption of using different platforms for payments. This one I find to be a little bit intense, a little bit scary. If I had one to choose that I'm probably most concerned about, probably the payments, but not all payments are bad. And some of them actually help bring transactions into the bank. I'll talk about that. And then you have the relaxation category of partners. Somebody's helping us. They're on our side. They're helping us with infrastructure that we need as an industry, and I'll talk a little bit more about that in detail. So breaking this down, the categories and the reason that the lending came to light, and the reason I'm not horrified just yet, is I understand what these people on the left have done and are doing. Lending Club, SoFi, Prosper. This is unsecured lending. Essentially what they've done is they've taken a space in the banking industry, which is our credit card portfolios, for those banks with big credit card portfolios, and they found a way, and some student lending refinancing, and they found a way to refinance this debt. It's a space that the banks ignored. Some might wonder, why did you ignore this? Well, they probably had some pretty high rates on revolving credit terms in the marketplace. Cabbage and on deck is the micro lending space. Let's not confuse that with small business lending. It's a very important distinction. It's under $1 million companies, typically under $100,000 loans. Some people are pushing the envelope on that. Those people pushing the envelope on that are also changing the way they're going about lending and becoming a little more traditional as they go up in size. So we have a micro lending business that's probably not very well suited from a structural standpoint to deliver small ticket loans with the infrastructure and the approach to sales that we have today. And then on the right side, you have trading and investment, robo-advisors. Again, going after the mass affluent segment primarily. This is really an interesting one. Again, we talked about a test and learn. I talked about it right before coming in. A test and learn strategy in this category. I don't think you do robo-advisory, plug it in, and everything good happens. And I'm certain that doesn't happen for the wealth and the ultra-high net worth who want to talk to somebody about how much money they have and what is going on. But you can't ignore some of the tools that are in the space. Payments. Again, the payments piece of it, you kind of have a couple different pieces. I'd say the supporters or working with and the attacking. You know, PayPal's still settling largely with credit and debit. They're still working with the banking system. Square, I would say Square allowed people that are using cash to use debit and credit. Not necessarily a bad thing for the banks. You get to the right side, and now you're talking about the payments field where people are trying to compete. PayPal is on both sides. PayPal's now come up with a credit product. That's competition. That's doing it in a couple different ways. Affirm, anybody know Affirm? Yeah, point of sale business, right? Where will that go? 6 easy payments, here's the deal, 20% interest rate. I just feel like taking a deep breath when I get to these guys because they're helping us. They're not competing. They want us to be better. They know they can make us better. Whether that's market intelligence, whether that's risk management, whether that's cybersecurity, in all these ways, shapes, and forms, we're working with many of these companies. I would even say on our digital platform, no doubt, we have co-development plans with firms right now to make sure that we are on the edge of what is possible, knowing that we don't have all the answers, but we can partner with companies that can help us. I think the important thing here is we need to know who the right company is, and we need to have expertise in-house to discern that, because it's not an easy landscape for banks. Imagine being a bank and knowing that there are several hundreds, if not thousands, of FinTechs that you could talk to in multiple different spaces. Now you start to get the idea of which space do I care about? Where am I plugging it into my system? Where is the threat? What internal knowledge do I have to do it? And by the way, when I choose one, can I execute? So that is how, in my mind, in the last 2 years, the banking industry has changed dramatically. So I'm running a consumer bank that I'm thinking about no longer my head of the business is going to do this, take this, and execute. They are not going to do that like that. They're basically going to do it by having somebody that's strong on the credit side, somebody that's strong on the modeling side, somebody that is a business IT partner, our IT department, somebody that's looking at the user experience, a project manager, a process manager. I mean, do you think that's the way banking worked even 5 years ago? No. So then we say, fact or fiction? FinTechs are riding up the favorable economic cycle and soon come crashing down. What do you think about that? Somebody said fact and somebody said fiction. I would say that you're right. You're both right. I mean, there's no doubt that delinquency rates and consumer credit is in a very favorable position right now. Pretty good indication interest rates are in a pretty favorable position right now. Let me see what the next slide is to tell you. when we look at the fundamentals, so I'd say that there'll be some winners and some losers, but as a banking segment right now, what I would say to our board and to our executive team is, you need to be sure and you need to understand clearly there will be winners coming out of this, and we need to learn from those winners, what they do, how they do it, and we need to become better at what we do. The consumer, as I mentioned on page 1, is demanding that. So this is a really fascinating slide. I'd focus on the left hand first. This is a near-prime customer. This is not the traditional space of some lenders outside of banking. This is a pretty good FICO score, good debt-to-income ratio, good credit history, good personal income. This is Lending Club. Now, don't laugh and say, oh yeah, we know about Lending Club. They got a headline recently. They're not. They've done some things really well. Again, foundation of this, removing the line of credit, APRs dropping a little bit lower to reflect the quality of the client they have. Then we look at the right side of this. And when, in the last 10 years ago, were banks talking about, could we fund this in 24 hours from app to fund? Can we fund it in less than an hour? Do you think there's a possibility we could fund this in 10 minutes? I'll tell you, it'd be really cool if we could fund it in 30 seconds. I would say this is a gift to the financial services industry, to the banking industry. This is making us think differently about what the customer wants and how we're going to deliver that. And we are thinking about these categories, and we're trying to decide, do you build it? Do you buy it? Do you partner? What do you do? But this is something that can't be ignored by the banking sector. Micro-lending often reflects best-in-class business practices. I thought, how much more powerful can you get than Jamie Dimon? He not only has a nice quote here, FinTech partnerships offer the kind of stuff we don't want to do or can't do, but there's somebody else that can do it. Man, I understand what he's talking about because I've personally interviewed with our team, 2 microfinance companies in the last 90 days. And what my reaction is we could do that. Give us 3 to 5 years, we could for sure do it. On deck, and this is not a commercial for On Deck, it could be any of the microfinance companies, but On Deck is at a 5th generation model right now on their underwriting platform. They've learned proprietary information, cash flow information, ways of looking at credit that we might have used, but not in the way that they're using it. They've tweaked their model to understand what's better and better and better. And some of those things you can only do through experience. That's why you're seeing a lot with the microfinance companies. Although you have Wells Fargo, 2 weeks ago, was it? They just announced their own micro-lending strategy, partnering with nobody. But they're Wells Fargo, man. Interest rates and downstream liquidity implications may pose the greatest risk of FinTech. I didn't say this just because this is happening right now. I actually gave a modified view of this presentation about 60 to 90 days ago. If you look at the bottom, this is basically institutional investing dollars. This is a risk to the credit, to the lenders. They have the risk of reputation, as we saw very, very recently. Your reputation changes, your sources of capital change, you got challenges, even with a solid business model underneath it. It makes it more fragile. What do the banks have? We have stable deposits, core deposits. There is not a balance sheet play on the deposit side of the ledger to date. That's credible. This is important to understand. It leads to, because people want someone they trust, that are sound, that are regulated. Again, you'll start to get the idea that I don't think banking's going away, but I do think that we are going to be integrating and learning from what our partners do. The other side says that rates are really low, so what happens when interest rates rise? It makes it a little bit more difficult on a FinTech company in the credit business because the banks still have what? Stable, low-cost funding sources. And that changes the dynamic a little bit. At what interest rate? I don't know yet. Vulnerability to liquidity crunch is playing out in recent events. You might have seen this. Again, I look at something like this and I say, yes, okay, Lending Club, we couldn't get the CEO quote, but we got their 10Q. Prosper, 28% of its workforce closes Salt Lake City office, downsized Avant. What does this mean? Well, it means it's a little bit fragile. It means they're working through a process to see what their returns are, what their margins are, what the promise is versus what was actual. Does it mean that we can't learn from their platforms? No, it doesn't mean that at all. You saw lending clubs underlying dynamics of what they do, and you saw the timing to market and what they're doing it. So I look at this, and it's not, I told you so, I knew this wasn't a threat. It's, yeah, we knew they had some vulnerabilities. We knew they weren't multi-line. We knew they weren't necessarily taking over the banks, but man, they sure have done some interesting things that we need to make sure we learn from. Okay, the next fact or fiction. Regulation will insulate banks from disruption. Fiction. That was intimidating to me. We got a fiction. Anybody? Fiction, fact, or fiction. Yeah, I think it's both also. But I would have to go, because you scared me, I'd have to go more fact. Wait, well, insulate bank. It's fiction. I think it's more fiction. I think that, yes, there'll be some people that don't survive. Yes, there'll be people that are more scrutinized. Yes, the banks have learned a lot about compliance and regulation. That helps us and hurts us because it has a huge cost to it. As you can see, $4.5 billion from community banks alone. And this says the year-over-year change in spend, and the number and percentage of banks are in that category. It's not a small number on the price you pay, and that makes us sad. So we want everyone else to be sad with us. Well, welcome to the game, boys. Looks like the SEC, the CFPB, the Treasury Department, the GAO, and state and local governments have taken interest in your business. Enjoy. But they have to. I mean, as these people become more substantial, basically what that means is for the, I guess, the soundness of the financial industry, which is important to confidence, which is important to the economy, these groups have to be regulated. Where are they going to start? With the very smallest ones? No. They're going to start with the ones that are most significant and make sure they have solid practices, make sure they have solid models, make sure disclosures are appropriate. What they won't do is do capital adequacy testing on their balance sheet. Why is that? They don't have a balance sheet. They basically are funding through institutional investors. And so they have that advantage, but from a fair lending standpoint, a transparency standpoint, a model validation standpoint, if you have a huge source that goes bad, you can create real problems in the marketplace. As we saw during the financial crisis, there's a reason for regulation in the industry. Some of it we wish weren't so intense, but there is a reason for it. That being said, it will not bring down solid players. I still think that you have, with the credit folks, you have some capital markets questions, you have some balance sheet questions, some funding source questions. But I think this can make the industry better. It will hurt some people that have bad practices, just as it hurt some banks that had bad practices. Okay, fact or fiction. Digital and mobile will disrupt the bank's role within the payments ecosystem. Yeah, I think probably more fact than fiction. It's pretty staggering when you see the numbers and you see what the role is, what's happening with these clients. So this is the one where I changed it a little from the last time I presented, because lending was hot then, and then payments became, I think payments is becoming the question. Although even that isn't certain where the big investments go. As sure as I put the number that payments was the big investment in the first quarter, I talked to my friend at Plug and Play, the founder of the FinTech group there, and he said, yeah, I don't think so. I think it was insurance. I talked to another friend who heads international innovation for BNP Paribas. He said, yeah, I think that's actually wrong. I think it's, what did he say? He thought it was data. I said, okay, well, surely it's one of the three or something else. And 1 quarter is difficult to get a trend in this business. I will tell you that lending was the hot button last year, and I think probably it's moving a little bit away. The bloom is off that rose a little bit. It doesn't mean they're all going. It means that it's going to shift, and there's a pipeline developing in some other places. I thought this was an interesting slide provided by Apple. if you've studied this for very long, and I actually labeled it, you'd know how funny that is. Because what it means is, okay, so in 2015, traditional payments and digital payments, 90-10. By 2020, it's 65-35, perhaps. And the very right side says 60% point of sale, 32% online, 8% mobile app. Yeah, I don't know. It seems pretty ambitious, but knowing the source, it was by Apple, and it is point of sale, and they did just launch Apple Pay. So maybe. I think there's definitely going to be more point of sale. 60% is a reach, especially when you think about internet shopping. I mean, my wife alone will make sure that that's more like 50% in the middle. And so it's not nothing, and it is changing how people think, and this is where I'm a little bit concerned, because I don't think it's a balance sheet issue that's about to happen. I think it's a disintermediation question and front of wallet question that's about to happen. Now, do you think that Apple is trying to bring the payments because they want the interchange? Yeah, they want data from the merchants, and they want to be top of mind. Period. They're getting 15 basis points on payments. Now, I thought this was one of the coolest slides in this whole presentation. So that 1.5 is the percentage of revenue for Apple in 2015 if they process 1 trillion transactions through Apple Pay. Yeah, I'm not talking billion, right? There's 1 trillion transactions. To date, they've done 10 billion. So if they get up to 1 trillion, that will then be 1.5% of their entire revenue. I don't know. I mean, you want to debate this for very much longer? This is not an interchange issue, I don't believe, for these particular companies. But to me, the disintermediation that we're starting to think about happens when we start to talk about the mobile wallet. This is what I think the real threat is, what it becomes, how you aggregate, how you make it easy. Because right now it's not that easy. You say, yes, this one particular app is easy. Can you aggregate 4, 5, 6, 7 different things into one place and change the way we're doing business? We're not talking about building a new bank, much like people weren't talking about building a new airline system. But you still have people disintermediating and going other places to buy airline tickets. They did not buy an airline business. I don't think it happens by somebody becoming a bank. I think this is interesting because guess what? It's not on the balance sheet. They're not using the balance sheet. They're using a platform. To me, this is one that I'm watching very closely. I'm having we used to have a credit card team. Now we have a payments team. And they're talking about how are payments going, where are they going, what form is somebody using. In fact, we met with about 6 different constituents last week, and we're doing it every 90 days. We're trying to figure out where we're investing and what we have to partner with in this space to make sense. I'll summarize this, although I think I've beaten it to death throughout this entire presentation. A majority of fintechs are monolines. Banks have intrinsic advantage of being multi-line. We have more data than anybody else, and we're using that with more sources of income than anybody else. It is important for us to understand the landscape. I think it's important to understand it in a way that you can actually attack it and decide what you're going to do. Otherwise, it's incredibly overwhelming. We expect many fintechs to survive through the credit cycle and through interest rates. And interest rates and liquidity will pose a challenge. Regulation is unlikely to entirely insulate, but I think they will do some good work through regulation, as they have done some good work in the banking sector. And then finally, digital payment providers are not looking to displace our balance sheet, but they're disintermediating our customer relationships. I'd go to the final. I don't know if I can go back once I go. Oh. Uh-oh. I knew these buttons were too complicated. I wanted anyway, Patty, you know. Nah, that last one.
Last one, please.
Can you do it just like that? That's awesome. So what are the banks doing? Right now, okay, yeah, I got this now. So FinTech fact or fiction. And by the way, my communications group said if I don't put that Twitter handle on there this time, that I'm in deep trouble. And I didn't even say, no, what's Twitter again? So we need to learn every day. The importance, I guess, let me back up one step. Knowing the group that I'm talking to, and as opposed to feeling like this is just a threat, what I want to do first is say thank you to the people in the room that have been part of this evolution of where we're going. You've taught the people in the banking industry a lot. If you're in the banking industry, most likely you're affiliated with technology, so thank you for that as well. This is allowing us to be relevant today and into the future, recognizing the importance of innovation and how we bring products to market, the customer experience and how it has changed, and then agility in responding to the marketplace. We need to understand our competition as a threat or opportunity, who to partner with, when to partner, and how to structure our company appropriately to deal with this change. Finally, we need to take advantage of what our advantages are in the banking segment. We need to understand what multi-line CRM looks like now and in the future. We need to be partnering with the right fintechs, and we need to be kind of joining the best of both worlds. The data we have, the trust that we have, with the innovation that we see in the right place, with the right company, in the right segment, at the right time. Not a simple equation, but a really exciting time to be in financial services. Thank you very much.
That was a great presentation, Andy. Thank you. Very insightful, a lot of good perspective. We have maybe I know you have a plane to catch. Do you have maybe one question? Any questions for Andy? Yes.
Can you tell me the aggregation law? Yeah. So, yeah, the aggregation that the banks are required to work with these firms, it is concerning. I mean, there was a major bank not too long ago that turned off aggregation, and the marketplace corrected them. They didn't need a law. And so what do I think about the law? I think it's happening regardless of the law or not. The bank basically said, we are shutting off our data to somebody, we're shutting off our data to outside forces. They had one aggregator that came in and one that we're thinking about partnering with said, yeah, you guys think you shut it off, but actually we had full access the entire time. A little bit concerning. They went and met with Jamie Dimon. He said, okay, so explain that to me. So I think the aggregation is real. I think you can't shake a stick without hitting it. I think that we are going to need to learn how to use that within our businesses. For me right now, I'm not positive how it's going to fully play out.